Hello and welcome. You're watching Bloomberg Quint, India's first digital live streaming business news service. I'm Shraddha Babla, and joining us on Thank God It's Friday, it's Aditya Narain, the head of research at Institutional Equities, Edelweiss. Good to have you over, Aditya.
Thanks for having me over.
Aditya, the month of September has been pretty volatile as far as markets are concerned, some of which, of course, have got to do with concerns around the Indian macro. So, are these concerns on the economy valid or mainly overstated? What is your view?
I think fundamentally these are issues that one needs to contend with, particularly this whole issue of job creation. But I think the way it's all suddenly come up in the middle of September is probably a little exaggerated. I think this scenario has existed for a period of time. It's just kind of boiled over in terms of the public's imagination or the market's concern. But it's not something that's actually new in terms of what's effectively happened.
All right. So, again, when we talk about GST pain, because that has been a big dampener as far as businesses are concerned, do you think this pain will last for a few more quarters and not just vanish at the end of Q2 like everybody was expecting?
I think there are two parts to it. One is the executional pain, right, which is issues with paying up and not paying and disruptions of that nature. I think that will be done by the end of this year. I don't think that should be that much of an issue. I think the other bit, which is the fundamental shift that is happening to regular businesses or to tax-paying businesses, I think that could probably extend a little bit longer. But the bulk of it you will feel in the quarter that's just more or less finished and the next 1 or 2 quarters. So I think there is that distinction. People are clubbing both of them together between the operational aspects of it and the structural shift that is happening.
Sure. All right. Also, a common view is that a correction of 5 to 10% is absolutely acceptable in any long-term uptrend. Are we in the midst of a correction given the valuations, or is it just that healthy correction that we are seeing?
Yeah, I tend to believe it's more that healthy correction, that cooling off of a bit of froth, rather than anything that is directional. I think it's far too premature. I think the premise of the upcycle that people are seeing is still very much existent. The macro remains robust. Nothing globally is changing materially apart from some North Korea kind of political issues rather than economic issues. So in that context, I think this is just a healthy correction, as you call it, a little bit of a cooling off, as I would call it.
All right. So to buy or not to buy, because that's the question on investors' minds. What would you advise investors to do right?
Well, we would be buyers. Our stated view is that the market is going to be 12-13% higher from here by the middle of next year. So I think every time you get pullbacks like this, just creates a little bit more of an opportunity.
Fine. So even at these levels, after the kind of pullback that we've seen today?
As I said, it's a healthy correction, the terms you used. I fundamentally believe that the markets will remain valued up. And the trajectory of both the economy and the cyclical elements of it are on the right side. So I think once you're on the right side of a both cyclical and structural move, I think it's a question of the opportunity that comes when markets fall off.
Just a quick question that I wanted to ask you on a near-term development that we're likely to see from October 1st. According to SEBI norms, companies will have to start disclosing if they're missing out even on a single repayment, whether it's interest or principal. I just wanted to understand, could we really see any sort of a negative impact on that? One, on banks, of course, and lenders, NBFCs, and second, on highly leveraged companies, because that's what people are really watching out for next week.
Quite honestly, I think as far as the highly leveraged companies are concerned, or the listed companies are concerned, or companies that fall under SEBI's purview, I think a lot of people are looking at them with a great deal of scrutiny in any case. Absolutely. So I don't think that's where the big challenge will be. The challenge fundamentally could be at the lower level, which SEBI has nothing to do with, which is the unlisted space, which is where you could get better trends in terms of what's happening. So I don't think it will be that much of a shaker. What you will have is a couple of surprises. So it won't be market-wide, but you will end up with a couple of companies that have fallen below the radar from an asset quality issue, which suddenly pop up.
Okay. Shifting focus to IT, and I believe you've been underweight on that sector, yeah. But we had a recent report which spoke about improving trends as far as pricing in US was concerned. Plus, you had a good set of numbers coming out from Accenture yesterday. I mean, do you really think it's time to allocate some money there, given the kind of underperformance that we have seen?
I think if you want to be defensive from a portfolio perspective, that's where you go. If you have a specific stock in mind where you think there is huge trajectory, like we think there are a couple of smaller caps which might have more momentum, I think then it's a place where you could, put a little bit more of your money. But at a portfolio level, particularly the way we see it, where we believe you should be aggressive with your portfolio, that's probably a more defensive space to be in.
Okay, so then what's the stance that you're taking on banking right now? Of course, we have RBI second list. There's uncertainty with respect to how that entire bankruptcy court and resolution will play out. Plus, you will have IFRS norms which will start kicking in, because that is something which will actually lead to significantly higher provisions. This is something which the street has not started factoring in yet. So how do you play, or how are you placed on the banking system?
Yeah, so fundamentally we are overweight. We have a huge overweight in that space. Within that, I'd say it's evenly balanced between the retail banks and the wholesale or the corporate banks, probably a little bit more biased towards the retail space. In terms of the whole shift to IFRS and the second list that has come out and the challenges it can create, quite honestly, I think the bigger issue is what is the trend as far as the underlying is concerned, rather than how it gets accounted for. To some extent, I think the trend has been pretty flat. You've not really seen an improvement, which is what the markets will like, but you haven't seen a deterioration in either way. And from an NCLT perspective, I think processes are actually much, much more streamlined. Right. So I would tend to believe that the market remains fundamentally very cautious in this whole space. The underlying remains stable. You could get some positive/negative surprises as the NCLT process moves on. But I would say all it requires is one or two positive developments in the form of a bidding war that happens for some assets that are being sold, that the mood can effectively change a lot. So clearly, I think there is an issue with asset quality. It's improving far too slowly relative to what the market requires and what we had actually argued for. But I don't see these accounting issues becoming bigger risks. It's the underlying where you need to see a trend.
All right, so if you're talking about the underlying, you also have this entire GST mess, which could actually have some negative implications as far as your SMEs are concerned. Again, there are significant lending that has happened to SMEs in the recent past, whether it be banks or NBFCs. So again, is the asset quality picture something that you should start worrying about again?
It's something that you clearly need to watch, because you really don't know the extent of damage this will cause, and it's not as if you'll see it up front. I think that's where people missing interest payments comes into play, but the SME doesn't it doesn't fall in that space. But I'd say that would be a risk element. You see, what the market has not been able to fathom, right, either on the upside or on the downside, is the transition pains, the transition risks, and the transition timing of this entire GST thing. So this is one of those variables that you would have to actually watch for a little bit.
Okay, I know you all, Edelweiss has come out with this big report on consumption theme recently, but what I wanted to understand is where are you more confident about growth coming, whether it's rural or the urban consumption bit?
From our perspective, clearly the urban side. Urban consumption, discretionary consumption, whether it is apparels, whether it is cars, I think from our perspective, that's a space that's actually running pretty well. Irrespective of what the market feels or how the market moves. So I think that's a space that's doing well. I think that has hit a kind of a J curve that should continue. And we would tend to be much more comfortable with that space. Given that it's a trend that's set in, we think there's structural elements, there's easier credit around that will actually continue to drive that. As far as rural is concerned, it requires a little bit of a kickstart, right? You've not got enough of it from a policy perspective. You've had a rainy season, which has been, at the end of the day, relatively mixed. So I think to kickstart something is a lot more challenging than to stay with something that's moving. And the consumption scheme, the consumption theme, I think continues to be it's something that's moving, so I don't see any reason to get off it.
Okay, but when you was talking about urban, the preference for urban over rural, is the state of the rural economy something that you're worried about, especially given the monsoon deficit that we have seen, and probably the fact that the rural economy may not even have completely recovered from demonetization? Is that one of the concerns?
I think our fundamental concern is more in terms of job creation, whether it be urban or whether it be rural, right? That's one bit. So I think to that extent, it doesn't lean towards rural. I think the second bit is, as far as the monsoon is concerned, we've actually argued very elaborately when everyone was very gung-ho on the monsoons, that the monsoons don't make that much of a difference, right? It's much more in terms of global commodity prices and the buffers you have globally and locally. So I think this slightly weaker than initially expected monsoon will not tend to make too much of a difference. But the third bit is this whole bit of kick-starting, as I said. I think that's always harder. And I think that's what the rural side requires, which it is not getting at this point in time, either from a policy perspective or from external elements like maybe the rains or, any other pronounced shift that is happening towards the rural side.
But then what about the government's target of doubling farm incomes in the next 5 years? Wouldn't that be a very big kick for the rural?
Well, I think, you need to see the specifics. Right. Obviously, if you can double incomes in 5 years, that means 15-16% per annum compounded growth. That's a huge amount, but you've got to see how they're going to do it. Because I think one of the challenges with agriculture is that everyone is worried about it, but nobody's really had hard fixed solutions beyond generic, let's create a supply chain and things like that. So I think you need to see the hard measures and then loan waivers don't do it. Right, so you've got to see something that comes through in specifics before one can make the call that they'll be able to double their incomes. As things stand, it'll be a challenge.
Yet another area where we haven't actually seen action on the ground is affordable housing, and this is what we've learned from our conversations with various real estate developers who are active in the affordable housing space. I just wanted to understand your view on housing finance companies, because a lot of these have run up on the back of this entire affordable housing push of the government, because otherwise loan growth seems to have slowed down. It's still a significant double-digit number, but it is showing a trend of slowing down. Is it time to become circumspect on these housing finance companies?
See, I think structurally it's a very good space. I think the pace of the ramp up that sometimes the market expects, which might be the case now, is probably a little ahead of the delivery. But, it's a question of, are you overvalued for tomorrow? Are you overvalued for day after? If you're not overvalued for day after, you don't have too much risk. Are you overvalued for today? Maybe a little bit. But I think as long as they keep the credit right, as long as they keep the economics right, because the challenge with a high growth area is that the so-called per unit pricing discipline tends to go away. As long as they can maintain that, or if rates continue to be soft, I don't think it should be that much of a challenge. But clearly they are factoring in a lot, and any lack of response from there will seem to be a pressure point for these stocks.
Aditya, any thoughts on the insurance space with a couple of new listings that we are going to see in this space? I'm not sure if you can comment on individual names, but you just had ICICI Lombard listing. You'll have SBI Life when we come back next week. Any thoughts on insurance and valuation?
Yes, see, fundamentally, in fact, one of the themes that we are pushing is the whole saving side and the liability side equation in the economy. We think that's just something that's going to last for a fairly extended period of time. We also tend to believe that rates will drop off more than what is generally been seen from a cyclical prism. So I think in that space, this whole area is actually a very interesting place to play. I think what you've also seen in this sector is that you've seen a lot of natural market consolidation, where the top 4-5 are just running away with the market and they're getting all the economies of scale. So I think a lot of these players will be very, very interesting entities to play, because this is just a structurally longer term kind of theme that is out there. And mind you, they've come out from their initial growth bubble or excess build-out challenges. So most of these are very clean businesses in terms of the books that they're running and the cost structures that they're running. So that makes it a lot more comfortable. This is not a first-time bull run. This is a second-time bull run, and that I think is actually a much better place to be in than has been the case with insurance in the past or other sectors, which might be the case today.
Well, a contrarian thought has also been the high equity exposures. Of course, I'm talking about the general insurance companies, which are more of a ULIP play rather than pure play insurance. I mean, how would you choose between a general and a life insurance company? Where would your preference lie?
Well, I think very fundamentally the life space is, I think, a more attractive space to be in, because that's where the entire consumer market plays out, and you end up getting businesses for a much get business for a much longer period of time. So I think fundamentally life would be in my view, a stronger place to be in than general.
And what about industrials and cyclicals? A clear no-no right now?
See, we like, in our portfolio, we've got industrials as an overweight, but it's actually not so much the capex heavy industrials. It's more the consumer durables which fall under that space.
Okay.
So from a pure cyclical industrial space, we tend to be a little measured. Our view is simple, that the capex cycle will actually take a little bit more time than what the optimists expect. And in that context, these stocks are a little expensive. I think the other thing also is that I think there's a reasonable glut of capacity when it comes to this whole industrial side globally, right? And so if that is the case, it will come down to India also if there is a demand surge. So in that case, I don't see, you might get some volume, but you won't get volume with price. And I think you'll get lesser volume than the optimists expect, and probably lesser price than the optimists expect again. So you'll see some uptake, but not enough to drive these stocks from where they are at this point in time.
All right, and just a last word on commodity-linked stocks, whether you're talking about metals or energy companies.
We like that space. We think there is a little bit more tailwind there. We think India as a market is good. There is a certain amount of protection these guys have. And again, this is the second bull run for a lot of these companies, so they are much, much cleaner. So we like that space. It's an overweight in our portfolio.
All right.
We particularly like zinc and aluminium.
Okay. Zinc and aluminium specifically, a lot of companies would fall under that basket among the bigger names. This is just a question which would probably help our viewers. As an analyst, what makes for your checklist when you're actually looking at a company to invest in? What are those key 2 or 3 parameters which need to be ticked off before you can actually go ahead and start actually considering that company?
Well, I think a lot of it is in terms of the space you're operating in. I mean, the word everyone uses is moat, so I won't get into that. But fundamentally, are you in a growth market where you have some competitive barriers to entry? If everyone can come in, then you'll have good players who will come in and knock down profitability. I think that is very important. I think how management has delivered and how it is geared to deliver, I think that is also important. It's a soft measure, and you seldom catch it in the first cycle. You will only get it in the second or third cycle. I think that is important. And I think the general balance between risk and return, how much of it is in the P&L, how much of it is in the balance sheet, I think you've got to consider that. So I think these things would be things that you take into account in terms of how you play. I think one of the things that in an India context, you also need to think of is, and that's where you've seen such huge returns from a lot of stocks, is this something that can go on for 3, 5, 7, 10, 15 years? Or is it something that is just based on earnings and then it is a more cyclical play or something that's more related to the nearer term rather than franchise building? So I think what's happened is franchise building stocks are the ones that have actually really got valued up. And that, I think, to some extent, a little more unique to India than otherwise, because I don't think you've seen the performance of some of the stocks that you've seen in India anywhere else in the world.
All right, and just the last question. Our favorite holding period is forever, is the famous quote from Warren Buffett. I believe he has also sort of not stuck to this of late. He's been seen some profit booking. But your view, what is an ideal holding period, or when would an investor know if it's time to really exit?
I think between the first and the third year, right? And I think between the second and the third year is the ideal period of time when you know whether the business is shaping up the way you'd wanted it to, whether the market is shaping up that way. And even if the stock's gone down, even if there are hits, whether they are for reasons of how the business is run or for purely extraneous reasons. So I think 2 to 3 years tells you whether it's a stock that you hold for forever or then you time to exit.
All right, Aditya, thank you so much for joining us here at Bloomberg Quint. It was a pleasure talking to you. And as for you guys, you can always log on to www.bloombergquint.com for business updates, and we will try to bring you more. But thank you for watching, and that brings us to the end of this edition of Thank God It's Friday.